simply because the market is anticipating rate cuts that just can't happen, and you get a sell-off. Then you might get a little bit of a reprieve until April, May of 2026, and then you do get your significant rate cuts, and then the long end of the bond market goes ballistic. That would be the more significant and more trenchant of the sell-offs. We are so overdue. I mean, I just I cannot imagine this can go on much longer. And I'm saying this from someone who manages money.
Huge news from China, Hong Kong drawing up plans to support gold trading. Special Administrative Region government is stepping up efforts to become an international gold trading hub and is reviewing related areas, including support for physical gold delivery, with plans to be unveiled later this year. As the city is making progress in building a commodity trading ecosystem, Chan underscored Hong Kong's advances in the non-ferrous metals market. Earlier this year, the SAR became a part of the London Metal Exchange's global warehouse network, an achievement he described as a significant milestone that has brought China closer to the world's most active metals trading markets. 8 LME-approved warehouses in Hong Kong have been operational since January, with more than 8,000 metric tons of exchange-registered warrants available to facilitate LME contract delivery as of early August, according to Chan. Beyond ensuring a stable regional metal supply, the move could also strengthen Hong Kong's shipping industry and support the growth of related services such as trade finance insurance and risk management hedging and derivatives. He added, the development in commodity trading is an example of Hong Kong's efforts to harness the opportunities arising from the technological revolution and a shifting global trading landscape to drive its economic transformation and upgrading in order to foster new growth engines, Chan said. So safe to say that BRICS master plan continues and the US dollar takes the L. Now, we'll show you the best clips of the latest interviews, but first, smash the subscribe button and turn on notifications so you do not miss out on our recaps. And check goldsilverstacks.com to get the Stacker's Handbook, the ultimate guide to trading the gold-silver ratio and increase your ounces. With this easy-to-read book, you'll know everything you need to know to stack efficiently so you don't have to rely on market commentators. Enjoy the episode.
Up 4.5% in platinum and 4.5% in gold. And I'm looking to increase that, but not at this moment. Listen, the bull market in gold is not exactly something that's a secret. It's outperformed the S&P 500 for the last 25 years. So it is a very long and protracted bull market. And the reason why I own 5% of it and not less, you have to have some. And I'm talking about liquid paper gold. I'm not talking about, I've always recommend you get 5% physical gold in your possession. You start there. And that's something that's an heirloom for your progeny. But if you want to talk about liquid paper gold, it's right now 5% because we have an insolvent nation with a currency that's weakening. And not only weakening against other flawed fiat currencies, but weakening against hard assets. I expect that to increase in a dramatic fashion next year. The only thing that gives me a little reticency about this is, like if I said before, if the long end of the bond market really becomes intractable and rates begin to spike, it is going to hurt gold as well. Not as much as it's going to hurt Bitcoin, and not as much as it's going to hurt the S&P 500 and the major league tech. I mean, that's where the big bubble is in that Mag 7. That's where everybody is sequestered, and the Apple, the Google, the Amazon, and because they're market cap weighted index, you have passive funds just flowing into those stocks, and they become so. If the 490 stocks in the S&P 500 haven't grown their earnings at all in the last couple of years, it's just those 10 stocks, and those 10 stocks have the highest concentration of ownership ever in relations with the other 490. So you have a massive bubble that when the plug is pulled, there will be a very narrow exit door. So you have to identify it ahead of time and get out. And as I said, this is a Thursday evening recording. This is not the case right now. I'm not out of the market. But if you wanted to try and get, and I'm not gonna guess today and hold myself to it, because I'm working every day. I don't have to hold myself to some kind of commitment to sell and set at the start of September. But an appropriate time frame, given the seasonality, and given what's happening in the next few inflation reports, according to my predictions, that inflation is going to run hot, both on PPI and CPI. And the fact that I believe the Fed is not going to cut rates by 50 basis points. You had Treasury Secretary Besson come on the other day and call for, and he did say it, I know he tried to walk the comments back today, but he wanted a 50 basis point rate cut immediately and 150 to 175 basis points in cuts in total. In a rather short duration. You'll wreck the dollar and you'll wreck the bond market. And I believe if you do that, it's all over for stocks. And you better be on the vanguard monitoring those systems very closely, because you're gonna short circuit your retirement if you don't. My transactions are not anonymous, they're immutable, and they're decentralized. None of those things are the case when you have the cryptocurrency tied to the US dollar and to the US Treasury complex. Everybody knows who you are, they know that you own it, and they're tied to the dollar, I thought these things were supposed to be rare and the protection against a falling dollar. So it's completely antithetical to every, supposed reason for these cryptocurrencies to have value in the first place. So that's my thought. I mean, if you're going to own a cryptocurrency, why would you tie it to the dollar and to a treasury bond? It doesn't. I think the demand for these assets is way overblown. It's going to underwhelm you significantly. I manage lots of money and I have lots of friends in the business. I don't know anybody who's interested in this, really. It's a very arcane, small demand, and it's not going to give a lot of supply to treasuries. I don't think so at all.
In today's news recap, gold prices higher as U.S. price data dims hopes of big Fed cut. Gold prices edged higher on Friday, buoyed by a weaker dollar, but were poised for a weekly decline after hotter than expected U.S. producer price data dampened prospects for a supersized September rate cut by the Federal Reserve. Spot gold rose to $3,340 per ounce. U.S. gold futures for December delivery edged up 0.1% higher. The U.S. dollar index fell 0.4%, making gold less expensive for other currency holders. In the short term, gold has a heightened inverse relationship to moves in the U.S. dollar, which in turn is being whipsawed by economic data and fast news on both tariffs and Ukraine. Independent analyst Ross Norman said, U.S. producer prices increased by the most in 3 years in July amid a surge in the costs of goods and services, data showed on Thursday, signaling inflation pressures in the pipeline. Weekly jobless claims also came in lower than expected at 224,000 compared to forecasts of 228,000. The data dampened bets, fanned by benign consumer price data and comments from U.S. Treasury Secretary Besson earlier this week that the Fed's next cut might be more than a quarter point. Non-yielding gold typically performs well in low interest rate environments. U.S. consumer price data showed only a marginal increase in July, briefly boosting hopes for a large size rate cut by the Fed. We have seen in the past that gold price corrections get smaller and smaller, suggesting that some buyers who missed out in the past use these price setbacks as a way to gain exposure to the yellow metal, said UBS commodity analyst Giovanni Stonovo. Now, smash the subscribe button and turn on notifications so you do not miss out our daily recaps. And go to goldsilverstacks.com to get the Numismatics Handbook, the perfect guide for stackers who want to get active trading gold and silver coins instead of selling their gold and silver bullions for fiat. Enjoy the episode.
The Bureau of Labor Statistics or with the Federal Reserve. There's some significant trenchant problems with both those institutions. But it's the opposite of what the president is railing against. So, for instance, the BLS persistently overestimates the number of initial jobless jobs numbers. And they underestimate initial claims perpetually. And then they go back ex post and revise them much lower. So if you wanted to damage the administration, what you would do is when everybody's myopically focused on the first Friday of every month, they would put out a really bad number and revise them higher. Listen, I'm apolitical. I just want to make money for my clients. I'm just trying to be honest here. So I'm not a political hack. So when the president does something good, I'll support him, and he does something egregious, I'm going to call him out on it. Likewise, he's railing against Jerome Powell, and the salient issue there is that he's not cutting interest rates fast enough. But the problem with the Federal Reserve isn't that it's perpetually over supplying the public with a positive real interest rate. The problem with the Federal Reserve is that it's chronically produced negative real interest rates. And for the last 20 years, most of that time, it's been a nominal rate that's been close to zero. And real rates profoundly negative. So if you want to pick a fight with the Federal Reserve, I'm in the vanguard. If you want to pick a fight with the BLS, I'm in the vanguard. Totally needs to revamp, but for the opposite reasons of what the president's saying. So, when you think about Banana Republic, you think about Banana Republic, you can't trust the data, the country is bankrupt, and the central bank works at the behest of, is a sycophant of the administration. So this is where we're headed. And you asked me, I'm going to answer your question in a very long, so thank you for giving me a little more rope. But I want to make sure the viewers get what they're paying for here. Get their money's worth. I'm still long the market. I'm net long. I am not net short. We've got precious metals, and we've got some foreign stocks. We've got defensive stocks. We're long the market, participating in this bubble, but the bubble is absolutely ready to crack. And I can quickly give you two reasons why I think the fantasy is almost over and reality is going to hit. So I will give you these two reasons. Number one, the labor market is fracturing and the economy is weakening. That is undebatable. Everybody understands this. This is not under any kind of, this is something objectively true. So if this continues, and I have every reason to believe that it will, what if the Federal Reserve is not going to cut rates significantly in the manner that is needed to support an eroding economy, an eroding earnings per share, and woefully disappoints Wall Street just because Powell just cannot cut interest rates when you get inflation numbers like we did today on the producer price index, leaping way over 3%. So that would cause the market to sell off. But I think a more likely scenario is we do get significant rate cuts, either by Jerome Powell or whoever he or she is going to replace him, an obsequious sycophant, as I like to say. That's a May 2026 story. And when they cut interest rates, the same function will happen as what occurred in 2024. So the Fed cuts the Fed funds rate. That's the rate that's applied to money markets, and long-term rates spike. Exactly what happened in 2024. In that case, in this case, if the Fed is going to cut rates aggressively, when inflation is waxing further away from 2% and really crushing the middle class even further, the bond market, investors might lose all confidence in the bond market. And then you have spiking rates on auto loans, student loans, corporate debt, and mortgages. So that would cause the market to crash even faster and further.
What do you think of Pento's take? Do you agree with him? Is a mega meltdown inevitable in 2026? Will BRICS master plan destroy the dollar? Is this all bollocks? Post in the comments section down below your honest opinion and share with the stackers your plan. Are you buying more gold and silver regardless of higher prices? Now watch this video right here because it's a perfect fit for you, and I'll see you on the other side.